Welcome back to the show. Today we're tackling a question that has fooled investors for centuries. If everyone wants to make money, why do markets often collapse just when confidence is at its highest? What does greed do to our minds before a crash? And how can ordinary investors avoid the same trap?
That's one of the most important questions any investor can ask. Here's the strange truth. Markets rarely crash when people are scared. They usually crash when people believe they can't lose. Greed doesn't announce itself. It disguises itself as confidence, optimism, and certainty. Think about it. When prices keep rising, your brain starts collecting evidence that the trend will never end. Friends begin talking about easy profits, social media fills with success stories, news headlines celebrate new records. Even people who never cared about investing suddenly become experts. This is where psychology quietly takes over. Humans are wired to follow the crowd. Thousands of years ago, staying with the group increased our chances of survival. In financial markets, that same instinct can become dangerous. When everyone is buying, it feels uncomfortable to stay on the sidelines. Fear of missing out becomes stronger than fear of losing money. History gives us the same lesson again and again. Before the 2008 financial crisis, many believed housing prices could only go higher. Easy money and endless optimism convinced people that risk had disappeared. It hadn't. Reality eventually caught up, and the market reminded everyone that prices cannot outrun fundamentals forever. The pattern repeats because human nature doesn't change. Greed slowly changes your decision-making. You stop asking, what could go wrong? Instead, you ask, how much more can I make? That's a completely different mindset. Risk feels smaller, while potential rewards seem enormous. That's exactly when discipline matters most. Professional investors know something many beginners overlook. They don't try to predict every crash perfectly. Instead, they build habits that protect them from their own emotions. They diversify, stick to a plan, and refuse to chase investments simply because everyone else is doing it. The irony is that the greatest opportunities often appear after fear replaces greed. When others panic, disciplined investors calmly evaluate value instead of emotion. That's never easy, but it's where long-term wealth is often built. So the next time you hear people saying, this time is different, pause for a moment. Ask yourself whether you're making a decision based on careful analysis or contagious excitement. Because markets move in cycles, but human psychology moves with them. And if you can master your emotions before you try to master the market, you'll already be ahead of most investors.
That was a powerful reminder that successful investing is less about predicting tomorrow and more about controlling yourself today. If this conversation changed how you think about markets, subscribe, share it with someone who invests, and we'll see you in the next episode.